question that I often get asked by new business owners is how should they structure their business? Should it be under a C corporation? Should it be under an LLC, a partnership? Should it be an LLC taxed as an S corporation? Well, in this video, I'm going to walk through the basics of an S corp. I'm going to start with a couple slides to kind of summarize what you need to do if you want to go down the S corp route. And then I'm going to spend the majority of the video showing you a populated tax return of an S corporation with all numbers and just kind of highlighting some of the aspects of it and how the S corp pays tax at the state level, at the federal level, how it flows through down to the shareholder level, what the shareholder gets from the S corp to report the income on their personal tax return. I'm going to show you distributions. I'm going to show you the payroll element of an S corporation. It's going to be a one business owner S corp, and it's going to show you revenue. It's going to show expenses, deductions. It's going to show all that. So if you have any questions after watching the video, please leave them in the comments below. And depending on interest from this video, I might create another one kind of focusing on some of the specifics of an S corp, like the distributions, like the wages. I'm going to cover those at a very high level in this video, but I might create another one. So thanks again for watching. Okay, so next up here are kind of 5 points that you should consider regarding setting up an S corp. So the first one here is Form 2553. So if you're like an LLC or a C corp and you want to be taxed as an S corporation, that's key. You want to be taxed as an S corporation. So legally, you might be an LLC, you might be a C corp, you might be a partnership, but you elected to be taxed as an S corp. You need to file this form. And I created a separate video on this form, how to complete it, where to send it. But typically, the due date to complete this form is March 15th. So if you want to be taxed as an S corp for all of 2024, for example, you got to complete this form and send it into the IRS by March 15th. It's a pretty simple form. It's 2 pages. Sign it, send it in. Then the IRS is going to review it, and once they accept you, they're going to send you a confirmation letter back. You want to keep that letter because it says that congratulations, you're going to be taxed as an S corp as of this date. That's point number 1. Point number 2, shareholder restrictions on S corps. So S corps can't have more than 100 shareholders. Shareholders must be individuals, certain trusts and estates. What we see often is an LLC becomes a shareholder, and that can't be the case. So you got to be careful on who's a shareholder in your S corp. Foreign individuals cannot be a shareholder of the S corp. So keep all this in mind. This is very important. Next is the class of stock. So S corps can only have one class of stock, such as preferred stock or common. They can't have both. So, we work with a lot of startups. They're raising capital. If you're thinking about raising capital at any point in the future, do not become an S corp. This is just a word of warning. Do not do that. It becomes a nightmare, a headache, and it could cost you later on down the road. So if you're creating like a lifestyle business, you don't intend to sell it. It's very profitable. An S corp is fine, but you just got to keep this in mind here, because once you start raising capital, there's different classes of stock, and by that alone, you kind of lose your S election. Number 4 is wage requirements. This is also very important. I'll cover this in the tax return example here. Is shareholders, they have to pay themselves a reasonable salary before taking any distributions. Now, reasonable is very gray, right? There's no definition of I run a certain type of business. Here's the exact salary I need to be paid. What the IRS is stating is you can't pay yourself a salary of $10,000 and take a distribution of $500,000, right? That's going to, cause an IRS audit, and you don't want to go down that path. You have to pay yourself a reasonable salary for the amount of work that you're doing, for the size of the business that you're working on. And then anything you have left over, you can take in distributions. But this is very important. And then finally is the tax filing form. Point number 5 here. So you're going to be filing Form 1120S. It's a federal form. It's due by March 15th if your year end is December 31st. And then depending on what states you file in, they're going to have a similar tax form. So that's going to lead in now to an example of an S-corp tax return. And I'm going to show you kind of the ins and outs of it. You'll see it's 1120. So again, these are the top 5 basic things that you should know about S-corps. All right, so here's an S-corp tax return here. And again, I'm going to just go through the very basics, kind of what's important, what to look out for. And most of you are going to have someone kind of prepare this return for you, but I just wanted to make sure you understand the flow of an S-corp and how it works. So as I indicated earlier, you can be an LLC for legal purposes, but you elect to be an S-corp for tax purposes, in which case you're going to file this form 1120S. It's due March 15th if you're a calendar year end. And you want to make sure you get that S-election form back from the IRS. So you can't just, file this form without making that election, that remember that form 2553 first with the IRS. So that's very important. We've seen people make this mistake before where they think they're an S-corp, so they file this return. They get a letter from the IRS. It gets rejected because they haven't gone through the steps on officially kind of making that election. And that election is not done on this return here. So here's page 1. You can see in this case, this company made the election on February 12th of 2022. And if this is kind of your first return, you indicate this is a first return. But this page 1 essentially kind of just tells the IRS, here's how much revenue we had as a business. This is what the owner got paid. Here were the other salaries and wages. And, items 7 through 22 are kind of like your deductions, right? So you start out with $940,000 of revenue. Here are all the deductions afterwards, employee benefit programs, rent, repairs and maintenance, and all other deductions. They get itemized elsewhere on the return. But you can see here, there's a limited number of line items. But it's if you think about it, it's more of like an informational return, right? You're just telling the IRS, here's what our business did. In this case, you can see the business had a profit of $560,000, okay? Now remember, the S-corp is a flow-through entity, meaning that the S-corp itself is not going to pay any tax, okay? It's just letting the IRS know, hey, this is what our income was, here's our expenses, and here's our profit at the end of the year. So now you're probably thinking, all right, how does the S-corp actually pay this tax or pay the tax on this income? I'll get to that. Another page in the return here is the balance sheet. And this is important. This is another reason why you want to use accounting software to kind of maintain your books and records. So, the balance sheet kind of shows cash, assets, and then liabilities, like credit card liabilities, bank debt, and it has the equity section here. So just calling out a couple sections here. So in this case, in this example, this business had an ending balance of cash of $431,000, had some other current liabilities. I think it was like prepaid expenses. There were some fixed assets that were depreciated. So here's the assets, and then here's the liabilities. I think there were some credit card liabilities, and that was it. There's common stock here, capital stock, and you can see here there's only like one class of stock, as I noted earlier, and then there's some retained earnings, okay? And these two numbers have to match, right? Total assets equals total liabilities plus equity. Now, another question I often get is, Rob, I have $1 million in our business bank account. Am I going to get taxed on that? And the answer is no, right? So in this case, you notice that $431,000 sits in the bank balance, but let's go back to page 1 here. Their net income is $560,000, and this is what's subject to tax. Okay, again, the business is, this S-corp is not going to pay the tax. It's the shareholders that pay the tax on this net income. But going back to that question that I get often, right? Especially those companies that raise capital, they have like tons of money. They have millions of dollars sitting in their cash account. You don't get taxed on what's in your bank account. You get taxed on what your profit is in the business. So now let's go to that question of, all right, well, how does the business pay the tax on that income? Well, the shareholders, So in this case, Ferris, he owns 100% of the company, okay? He's going to get a K1. And this K1 is generated from the business, okay? So the business is part of this whole return, this tax return, this 1120S, it creates a K1. And the K1 is given to the shareholder. And then the shareholder puts this on their tax return, okay? So in this case, the business had $560,000 of income. Ferris is going to put this amount on his personal tax return, and he's going to have to pay tax on that end income in his personal account from his personal tax return, okay? So this amount is going to show up on his personal tax return. Now, the IRS tracks all of this is because on this K1, I didn't put it here, but Ferris will have a social security number. Here's a business's EIN. So once the business files this, then the IRS knows, all right, when we look at Ferris's tax return, he better show $560,000 of income. If not, we're going to send him an IRS letter. So that's kind of like the whole tracking of this. And then another piece on this K1 shows distributions. So box 16D. So Ferris, he took a salary. Remember I talked about reasonable salary, and I'll get to that. He also took distributions because he had a lot of cash in the business. Here's the distributions here. And these distributions, in Ferris's case, are not subject to tax. He's not going to put this on his personal tax return, okay? That's the beauty of this. But he is going to have to pay tax on this. So if Ferris was smart, he would have saved some of this distributions, knowing that he's going to have a pretty, big tax liability on his personal tax return. So another form here is officer compensation. So here's Ferris, owns 100% of the company, and here is what his W-2 was. And this is pretty reasonable, right? The business is almost $1 million in revenue. He paid himself $176,000. His W-2 from this company is going to show $176,000. Let's go back to the K1 here. And that $176,000, let's actually skip to page 1 here. That $176,000 is right here, and that's a deduction, okay? So he's getting paid by the company. That payment is a deduction, right? It's reducing that $940,000 of sales, because the whole objective is find deductions that you can offset this total income. So, and then he's got some employees that he paid $125,000. So his net income at the end of the year is $560,000. He's the only shareholder, okay? Now just say there were 2 shareholders, okay? There are 2 shareholders and they each pay themselves a salary, and at the end of the year, this is the net income of the business. If there was shareholder 1 Ferris and there was shareholder 2 Sloan, and they were both 50-50 in the company, this K1, you take the 560, 650 and divide that by 2, this would show $280,000, okay? And then Ferris would put that $280,000 on his personal tax return, and he would pay tax on that, okay? So that's, and then one other page I want to point out here, which is very, very important for S-corps, is the tax basis schedule. And if you're an S-corp owner, you have to put this form on your personal tax return. You have to. The IRS mandates it, and they want to see it. And the reason why is this tax basis. And I'll probably create another video on this because it gets a little complex. I don't want to overload everyone here. But essentially, the reason why the IRS wants to see this is people will take distributions. And like I said earlier, distributions are not subject to tax. But if your basis in the company is negative and you take distributions, those distributions are subject to tax on your personal tax return, okay? And that's why they want to see it. So they want to see the company's basis and your basis in the company. So that's very important. And again, this form is, you got to have this prepared. So if you're working with a CPA or you're having them prepared, do your S-corp return, and they're not preparing this, you want to make sure you get that, because this is going to protect you. Plus, it's also required on your personal tax return. So those are kind of the basics here of the S-corp. like I said, it's more of like an informational return. I mean, there's a lot of work that goes into it, depending on how complex the business is and how many shareholders there are. But you're essentially just telling the IRS, hey, this is what we made. But then it's up to the shareholders on their personal return to pay the tax on that net income. So you always want to plan, and that's why doing quarterly tax estimates, meeting with your CPA frequently to kind of plan for this, because what you don't want to do is your S-corp files its return, you get this K1, and you're stuck with this huge tax bill on your personal return. If that happens, then there's something broken in the system with you, you're in your CPA, and you're not planning accordingly. So again, if you have any questions, let me know. And if there's other things you want to see in the video, let me know, and I can create some other ones. Thanks.